Now to a Fox 5 consumer alert. The Federal Reserve taking action to try and curb rising inflation. Yesterday, the central bank announced it's raising interest rates by a quarter percentage point. Interest rates were eased 2 years ago to help the economy weather the pandemic. Now the Fed is reversing course, saying it will continue boosting these rates. Joining us this morning is Virginia Tech economics professor David Bieri to share insight on how this move will impact your wallet. Good morning to you, David. Good to see you.
Good morning. Good to be on the program. Happy St. Patrick's Day.
Happy St. Patrick's Day. Listen, maybe not so happy talking about this topic. We've been talking a lot about people's wallets and their bank accounts. The question really is, how will this affect people's credit cards, mortgage, saving rates, things like that?
Well, the Fed's in charge of short-term interest rates, not all interest rates, but it changes the price of money. And in that sense, the Fed is affecting what it will cost for people to borrow money. That's the bad news. In some ways, the good news is that it will also influence how much people will make on their savings account. So finally, we can see the needle on those interest rates on our savings account go up. But you see, the interest rate can be viewed almost like the accelerator or the brake on a car. And so what the Fed has decided to do, it needs to step on the brake a little bit, not too much, just a little bit for now, so that the economy cools down a little by making money more expensive.
Yeah, and I want to revisit that actually a little later. But first, I want to ask you, when you mentioned earlier, this is the first of several rate hikes this year. How high could the Feds go?
Well, it depends. Currently, the market is expecting that the Fed will raise rates until at least 2%. Some people think it might go a little more, 2.5%. And then it's anybody's guess. The real question is, how well is the economy going to react to this? And so the Fed will have to wait and see. But it's announced essentially that it will continue doing this until rates are at least as high as they were before the pandemic.
There's been a lot of talk because we had been anticipating this rate hike happening this month. Then the war in Ukraine happened. And so there was a lot of question as to how high the Feds would go. What role does the war in Ukraine play in all of this?
In some ways, a short-term role. We've seen oil prices additionally affected by the crisis abroad, but in the long term, it will not affect the health of the American economy, which is primarily what the Fed is worried about. We are currently not worried about an international contagion, that there is some sort of financial market spillover because of the war to the globe. So this time is quite different. It's a domestic affair. Of course, we're seeing other countries struggling with supply chain issues in the same way that the US is, and seeing that container ship stuck in the Chesapeake is actually quite symbolic for what's plaguing the economy right now. So whilst the economy is in a good trajectory, there can be something like too much of a good thing. And so the Fed just has to walk that tightrope that it doesn't choke off the good thing, but as some people have referred to it, is taking away the punch bowl at the party so that people perhaps do not get too happy or too merry going forward.
And that's actually what I want to get into. You mentioned that metaphor earlier, which was a good way to put it as far as the Fed's kind of putting the brakes on this. There are perhaps a minority of economists who say this is too much too soon, and that they're worried that it could trigger a recession. What's your view on this? Do you think perhaps is it too early, too late, too much?
I think that they're finding the right balance. Now, you see, when we talk about the Fed, we talk about this great institution as if it had one voice, but it doesn't. It actually has several voices, and there are some people, even inside the Fed, who thought that this was a little too timid. But the overall consensus is that this is just the right amount. Some people were thinking that they might hike rates sooner, more aggressively. But again, like a good doctor who has to feel the right pulse of the patient, it's finding the right tempo and the right tone as well, because this is not about spooking investors. This is not about spooking people. This is about saying things are okay. We're headed exactly where we want, but we need to be careful. Now, we could look back and say, well, did we make mistakes in the past? Haven't we all? And so right now is not the time to be doing some sort of a Thursday morning quarterbacking and saying that if we could go back in time, maybe the Fed shouldn't have made money so cheap in the past.
Yeah. All right. Jerome Powell saying a lot of those things you said in the last few seconds there. A lot of wait and see. We'll have to see this year what they decide to do, depending on how the economy and consumers react to all of this. Virginia Tech economics professor David Bieri, thank you for breaking this down for us this morning. Appreciate it.